Welcome to Crypto After the Crackdown. Clearly, I would actually say that the attendance suggests exactly what's happened. We're no longer quite so hot. We have an absolutely fabulous panel who can help us sort the wheat from the chaff and the fraud from the legitimate business model. Some of them are already in the promotional videos, so hopefully you enjoy it. Going this way, we have John Palmer, president of Cboe Digital, and himself a former employee of an international crypto exchange. Now, he's gone legit, though. We've got Sheila Bair, who is the former chair of the FDIC, who has also sat on the board of a company that does stuff with the technology that's behind crypto. And she's also, did most people not know, she's a children's book author. If you want to teach your kids about finance, her books are great. And then Josh Oliver, who is the FT reporter who interviewed Sam Bankman-Fried, and in fact has just won a very prestigious UK journalism prize for that interview. So if you have not read it, and you're all FT subscribers, so I know you can get it, go look it up. It's unbelievably good, his magazine piece. And I am Brooke Masters, the US financial editor, and I'm the crypto newbie, and I get to ask the dumb questions. So, it's been a weird and wacky couple of years in crypto land. You know, Bitcoin is $18,000, $32,000, back down again. It's a roller coaster. Let's talk about where are we now? You know, what's the future? Josh, John, why don't you start?
Yeah, and I mean, I think we've clearly seen some pretty severe cycles and really very quick cycles compared to maybe how we've experienced them in other asset classes in the history. But I think when we think about at Cboe Digital, where we think about where we are in the history or in the landscape for US crypto, I always use this terminology as think about your favorite sporting event. And I really think we're still before the national anthem. Right, or I think in our pre-talk, I used the example of the Apple computer, and taking something that was incredibly complex and making it very simple, but still there was massive amounts of time before you saw mainstream adoption of that technology. That's where we're at with crypto, in my mind.
Josh, when we look at crypto, tell us a bit about why it is that suddenly everybody thinks it's a fraud.
Yeah, I mean, I think people are looking at the evidence of the last couple of years. I mean, particularly the last year, we had a huge swing up and then a very, very dramatic swing down in crypto. And I think, if you were making an analogy to the mainstream financial sector, you would look at crypto and say, 4 or 5 of the biggest banks failed. And the biggest one obviously is FTX, which is featured in the promotional video. Which is actually an excerpt from our FT film, always hard to watch yourself. But you get some clips there also of our interview with Sam and the footage that I was recording on my laptop at 8 in the morning on a Saturday when I was interviewing him at 3 in the morning for him in the Bahamas at his request. But this FTX episode I think is really significant in terms of where we are with crypto, because this was the most prominent face and voice in crypto and the most prominent advocate of kind of a responsible version of crypto that then proved to be, completely without clothes as the emperor and, rotten to the core. And, that has an inevitable effect. So, if we are before the national anthem, which, may well be true, it's, the bit that has happened has been pretty disastrous for the reputation of crypto. And I think the other thing that we've seen is it's not about one individual company like FTX that has, come to grief. You've had a number of these, and through the investigations that have been conducted, you've gotten a lot of insight into what was going on during the run-up in crypto values, what people genuinely were doing and saying inside these companies. So your request, I've prepared a couple of little
examples, like why should you be skeptical of crypto?
Yes, examples for you. So this is crypto executives in their own words from some of the companies, not all. But these are real messages sent by crypto executives to other crypto executives in private chats that have now come to light years later, okay? From our friend Sam Bankman-Fried, we sometimes find 50 million of assets lying around that we lost track of. Such is life. So that's not good. Another company, Celsius, which we did a lot of work on, is a crypto lending business. And this is a quote from one of their employees in a digital message. If anyone ever found out our position and how much our founders took in USD, it could be a very, very bad look. Which obviously they did find out, and it was a very, very bad look. and the founder's now being sued for fraud by the New York Attorney General. And then finally, Binance, still the world's largest crypto exchange, still going concern, who have lawyers who could sue me. So have to be more careful. But this is one of their executives in the past writing to another executive about their customers and what their customers are doing on the platform. Quote, come on, they are here for crime. So, this is the glimpses that we've had behind the curtain of what was going on. I mean, it's not, every single person who's ever touched digital assets is bad, but I think, a number of these institutions have been shown to have really, really serious problems and have hurt a lot of people. So, it's not a good first quarter of the sporting fixture.
It's like we've had the 1918 Black Sox scandal before we even had the first inning of baseball.
Yeah.
Sheila, you obviously regulated banks, which is a completely different thing, and
Right.
these are not banks, and they're very, but I think you're probably in a good position to say, like, how do the regulators approach this and try and help turn this into something legitimate, if there is something to turn into?
Well, I think there is something legitimate, and the sad part about it is that the Sam Bankman-Frieds and others who are hyping crypto, we're talking about the potential socially beneficial uses. Democratizing payments, going to real-time payment at settlement. Reducing concentrations of power through these huge intermediaries that we now have that rely on the financial system. And so those were all things true about the potential of technology, but what was going on was not that. It was, creating a bunch of, funny coins and speculating and lying and misusing customer funds and doing a lot of other nasty stuff that has come to light now. And that's not everybody, but I think there has been a good a part of it that it's just been, speculation at best. So now we're understanding that's not really socially beneficial or helpful, but I fear we may be throwing the baby out with the bathwater now and trying to shut everything down. And I don't think that is wise. I think stable coins, for instance, have a real promise. Properly regulated, properly reserved stable coins have tremendous promise to make payments real time, very low cost, especially immigrants. For years in banking, and as Assistant Secretary for Treasury, I worked on trying to lower the cost of remittances for people working in the United States trying to send money back home. It's still too high. So there are uses like that, and just be able to track ownership, the ownership of assets. How many of you have paid a lot of money every time you bought a house for title insurance? Raise your hand. I know I have. So wouldn't it be nice if we could just put the title of those those homes onto a blockchain? You'd have a mutable chain of ownership, and you wouldn't need that kind of rent seeking anymore. So there are good uses of it, but now I just feel like the reaction is shut them out, say they're all securities, so they all can't be, they can't do business at the banks. And eventually that is, I don't think it's going to kill the technology. I just think it's going to send it overseas.
John, Sheila's given us a couple of concrete examples. You guys are actually trying to monetize this and do legitimate business to a certain extent. Talk us through what are some of the really good and promising uses of this technology?
Yeah, I mean, I think, and clearly Cboe Digital is the digital exchange and clearinghouse arm of Cboe, and our mission generally across all the markets we operate globally is bringing a trusted, transparent, robust market where people can exchange or represent their risk, right? So you have a buyer and a seller, and you want to be able to expose yourself in the way of you want to be a buyer, you want to be a seller, and you want to do that someplace you can trust, right? And so that's what we're trying to bring and what we're bringing in the digital or the crypto landscape. And I think to both what Sheila and Josh said there, we sometimes get lost in the sea of the bad actors, right? And there are a tremendous amount of good actors trying to bring this technology and bring these types of operations to the mainstream, right? So that if you want to buy Bitcoin or Ethereum or whatever token it is you want to, you can do so safely. And I think that's really important. And I think knowing how some of the platforms in the US are structured, you can do that today. It's there, right? And you should be able to access it the same way you buy an Apple stock through your Fidelity account or through your Interactive Brokers account or whatever broker dealer you want. And so that's the genesis that we believe at Cboe Digital and what we're trying to achieve. I think, Sheila mentions, stable coins. I think the velocity of money or the ability to move funds, right, I think is really interesting. And that doesn't really necessarily have to do with Bitcoin or the token. It has to do with the technology behind it all. Now, these these blockchains have these tokens that sometimes are built into them, and so then there's obviously people that want to buy and sell those, and there's a value associated with buying and selling it. But I think the technology underneath it all is what's really still really untapped, right? So we've talked about stable coins. We might talk about central bank digital currencies here. You could talk about settlement, right? We've seen financial markets move from settling your securities on a 4 or 5 day basis to now we're moving to a 1 day basis, right? And how that gives benefit to the people that are actually holding and doing things with those securities. Think about moving to an instant settlement or moving to seconds in settlement. That's what the technology has the ability for us to do, but we're not there yet, right? We have to walk, and then we have to maybe jog, and then we can run.
Josh, you spent a bunch of time talking to people who were trying to sell the sort of crazy, the tokens, not the technology. From your opinion, from what you encountered, was there a value in that, or is that really just like it's lottery tickets on the next, and on one side there are actual exchanges and then there are lottery tickets?
Yeah, I mean, I think there's an interesting idea that's represented there, which if you think about people always love the analogy between the sort of early internet and or the internet of sort of information, and then crypto as putting money into the internet, which I think is actually an interesting analogy. What the internet did to publishing was, previously you had to be an institution like the FT to publish, and we had the infrastructure to do that, and basically the public received our published material, and then we changed to a world where everybody could publish because everyone has Twitter and everyone has Instagram, and everyone can express what they think. And I think the idea that was present in crypto was, what if everybody can issue some kind of financial instrument that other people can invest in, and that I could just wake up in the morning and create Josh Coin and tell you what I'm going to do with Josh Coin, and if you guys believe in me, you can give me money, and then I might carry. So that's a very interesting idea. Is, do we want to have super democratized kind of investment markets, or sort of investment opportunities on the internet where you can do that? But I think if you looked at what has happened in the last crypto cycle as a test case of what happens when you make things that democratic, I think you might conclude that that's probably a little too democratic. And maybe there were good reasons why we said that there should be guardrails around the activity of creating something that the public can invest in. And I think it's pretty uncontroversial to say there definitely should be those rules, because there's been a lot of abuses in the crypto sector, and people really profited off of that optimistic idea that they could sell to people. And I think some of the most troubling parts of the crypto story for me were when you saw companies that had a sort of predatory marketing towards people who had less financial awareness, less financial literacy, maybe less more vulnerable, and were looking for some sort of alternative. And I think we do see examples of that with some of the crypto operations that have now come to grief. And that is maybe the worst part of it, because people were looking for an alternative to a system that wasn't working for them. Crypto comes along and says, we are the alternative, it's going to be great, and then they let them down. They betray people again, and that's part of what the backlash is about.
How do we resuscitate that and save the good part? I mean, is the answer to have only central banks can issue digital currencies, or only regulated companies can issue stable coins, which have a fixed value? Do you think that's doable? Is it a good idea? What do you think, Sheila?
So I think you need both. I think it would be a good thing to have a CBDC, but I don't think that should crowd out privately issued stable coins as well. Again, if they're properly regulated and the controls and compliance are around it. I think in terms of a government issued digital currency, whether it could be the U.S. Treasury Department, it doesn't have to be the central bank. I've always thought that payments for fiscal stimulus or just benefit payments, using this technology to make sure, there's so much fraud in these programs, and you saw it during the pandemic. We had to get money out the door fast because there's a lot of stress in the economy, but that comes with a lot of fraud. Unfortunately, that's just it. So using smart contract technology so you have it on the chain, so you know who it's getting to. If you want to restrict it for housing or rent or whatever, you can build that into the contract. I think that's got tremendous promise. Or even just monetary policy. This is a little more out here, but I've been talking about it. I think I first mentioned it to you a few years ago in your jaw drop. But if you want to print money to stimulate the economy, we have found that doing that through the financial system really isn't a very efficient way to do it. So if you want to, if the central banks are going to print money to stimulate the economy with congressional approval, you could use the CBDC to just put it directly into households, let everybody have an account, or you could do it through privately issued digital providers. There are some very credible people with some very credible proposals out there to do that. So I do think for consumer payments, either stimulus or benefit or some combination of both, I do think that some type of government issued digital currency is important. Another reason, again, this is touchy, but it's honest. China's way ahead of us on this, I think, and that's part of their strategy to make the yuan eventually the global reserve currency. There are lots of countries that do not have stable currencies that have people who would love to be able to own dollars, but they can't have a bank account in the U.S. But having a U.S. dollar-backed stable coin is a way that they could have a stable currency. And so this is a way that you could help reinforce the prevalence of the dollar. It's what's going on. I think that China is using its digital currency now in just that way. And so we need to think about that, whether we want to or not. And countries say, well, we don't want our people to use the dollar. We want us to use, Argentina or whatever. Well, fine, then get your act together and stabilize your currency. Then there won't be a demand for U.S. dollars. But right now, there is a tremendous global demand because people still, notwithstanding our problems with the debt limit and everything else, people still have confidence in the dollar. They want to own it, and stablecoins are the best way to do it.
Do you have a sense about how one can make sure that digital currencies are legitimate and not a place for fraud? Because presumably if Cboe is giving you access to something that then turns out to be a fraud, that's probably not good for you guys either.
That's true.
Yeah, I mean, I think, number one is, we've been very prudent in the tokens that we offer on our platform, and so we only offer 4 of them, and we did that intentional, by design, given the U.S. regulatory framework isn't as clear maybe it is in some of the other jurisdictions, like we see with like MiCA coming in Europe and things like that. But I think as we see that evolve in the U.S., we'll have able to get our arms maybe around it better, and I think the goal here should be for us to find ways to prudently offer these services, whatever crypto type you want to call it services are, whether it's an exchange, whether it's getting structured products because you want to generate additional yield, or it's you want to buy your favorite NFT because you went to a concert and there was this cool swag you got because you're an NFT holder of Bruce Springsteen or whatever it might be, right? Who knows, whatever the use case is. We need to be able to offer these in a wrapper that customers understand and trust. Mm-hmm. And a lot of these types of services are already offered in different wrappers that aren't tied to crypto, right? And so, we believe that the goal really should be is let's get our arms around it and let's offer proper disclosures, proper rails, proper know your customer rules, right? We have a huge banking sector that's been doing know your customer type things and anti-money laundering type things for a very long time. And now all of a sudden we have had this crypto industry where there's a tremendous amount of institutions being stood up that are maybe nascent institutions, but are now doing those services because banks can't or aren't willing to. And so we're basically dividing that from the system that we've built over hundreds of years in the U.S. that have served us very well. And so I think by finding an avenue to get it in there prudently, and it doesn't have to be all 5,000 tokens that are, out there in the world, it can be very limited, but again, that kind of very prudent view of it, I think it could really open up the adoption of it. And I think opening up the adoption of it actually adds a tremendous amount of stability to the market. And I think that has huge benefits for everybody that's in it, in that sense that the swings we won't see as much, and there'd be more safety, more trust, more oversight, more governance, all the things that we kind of come and love, but maybe take for granted when you're buying a stock.
But as Josh pointed out, a lot of people were attracted to cryptos precisely because it was not part of the system. And Josh, you've spent more time talking to people who actually buy the stuff. I have to confess, I kept telling my kids, please don't waste your money. I probably was wrong, because if they had speculated, they would have made a lot. Do you think one can have a safe, regulated crypto, or does that defeat the purpose in the minds of most people who are using it?
I think it would defeat the purpose in the mind of many people who have used it in the past. which it doesn't mean that it can't be a good idea for the future necessarily. I think what you have seen is, in the bulk of the crypto market, and I want to be careful because it's not fair to tar everybody with the same brush and say, the stuff that, for example, you've been working on has been, trying to move in the right direction and trying to build the right kind of market. But while you've been trying to build the right kind of market, I think that the wrong kind of market has exploded and then collapsed, just in the course of basically a year and a half, while the more responsible players are moving slower. And so, you had a huge part of the existing market and the share of the volume that, represented either kind of, extreme speculation that we might not think is a good thing, or, wanting to move money in a way that wasn't, within the traditional financial system, because you were trying to get around the controls that are built into the traditional financial system. And a lot of the big crypto players are now in trouble for that kind of activity. So I think, if you think about the house of crypto as it has existed in the past, and is it, do we need to clean the carpets and change the paint, and then we're going to be able to carry on and have a good house, or is it dry rot, we got to knock this thing down and build another house with the same technology? I think we're more building another house, and I think actually the foundations are already laid because of some of the work that's being done. But the market that was, I think, is very hard to defend.
One of the things, I was talking to a bank regulator who said one of the from his point of view, one of the good things was that their insistence that banks not be allowed to hold crypto meant that this whole rise and fall happened without taking the rest of the banking system with it, although you could argue that Silvergate and Silicon Valley are on the edge of crypto. Do you think, if we're going to build a legitimate house, does it get to have like a carport over to the banking system? Can it? I mean, how dangerous is it to sort of start sharing the resources? Do you have a sense?
Yeah, well, I think you need to distinguish between investing, taking a position in crypto, taking exposure in crypto, which I don't think banks should do, and being able to give traditional banking services to crypto firms. And I think those are two very different things, and they get confused. So I don't think banks should be owning or speculating in crypto. That's the last thing they should be doing. I do think legal crypto firms should be able to have a bank account. And if you're a stablecoin issuer, that money people still want to buy the stablecoin, they want to redeem the stablecoin. Those payments, that money has to go through a bank for that business to operate. And that's, I think, what the issue is now. And both Silvergate and Signature had specialty businesses that were around that. There was a lot of volatility with redemptions when FTX exploded, and that did get the banks in trouble. So I think if they're going to do that business, they need to have, it's manageable. You need to invest in very short-term treasuries to back it. And they didn't manage it well. But it's important to understand that's what got them in trouble. These were traditional dollar, checking accounts, or operational accounts, if you will, where money was going, real fiat money was going in and out. They weren't exposed to crypto. So I do think, if it's a legal business, I think anybody, even, and I really don't like payday lenders, I don't like gun dealers, a lot of industries out there I'm not really a big fan of, but if you're legal, you should be able to have a bank account. And that's true with a crypto firm as well. And if Congress wants to say no, then Congress should say that. But that's really what the issue is about. Beyond that, I think I think they're right. I think the size of the crypto market, even with the spectacular losses, was not big enough. I think even if banks had been massively investing in crypto, it probably wouldn't have been a big deal as part of it's a $23 trillion banking system. I think it could have handled it. But the point of they weren't exposed, and I think it's good that they weren't exposed. I agree with the regulators on that.
How are you guys figuring that? Because obviously you're exposed to businesses that are exposed to crypto. How do you make sure that you stay within your regulatory guidelines and not get drawn into, say, money laundering?
So yeah, I mean, it's a great question. I think specifically in the U.S., there are very strict rules and guardrails in which we operate as a crypto exchange, right? So we have money transmitter licenses in states. As part of those licenses, we have stringent know your customer KYC and AML, anti-money laundering type of rules that we have to have in place. So we have a very strong we have processes and controls internally, so that way if we were to onboard somebody and they were to become our customer, we are certain they are who they say they are, and we are certain that we understand where the flow of money, or potentially crypto if they bring it to us from somewhere, from some other wallet, that we know the source of that. and we know where it's coming, and it's not for potential money laundering purposes. Now, that's put in place for us in order to operate like that in the US, right? So that already exists today. It's more of, could you go stand up a platform in a international jurisdiction that maybe doesn't have as stringent or as well-defined processes like those? 100%. And there are platforms that are out there that you can find to do that, but I think it's do your own research and understand the risks involved in which you do business with that type of platform. And I think that goes with any sort of counterparty, whether you're an individual investor or you're a large-scale institution. If you want to use a VPN and access an offshore venue, you can. Should you? No. Are you allowed to do? Technically, no. But you're taking on risk by doing that, and you should understand the risks associated with it by doing that. And I think maybe that's where a lot of folks have lost that, is understanding what risks you're taking by doing business with those types of venues.
Well, yeah, and BSA/AML risk, that's a completely different issue, and that, banks should be tough on that. I hope banks are tough on that. I do worry that to the extent, banks are getting less and less acceptable to crypto firms and stablecoin issuers in particular, the business is getting concentrated just in a couple of banks, so that creates risk. And then a lot of it's just going overseas where you don't have the same kind of stringent due diligence requirements, KYC, know your customer requirements that you would have with US banks. I mean, ironically, a lot of the FTX mess and then the depegging of USDC has forced a lot more money into Tether, which is there's much less transparency around Tether, much less uncertainty about what's backing that. Than certainly you had with USDC. They made a very unwise choice by keeping so many uninsured deposits with the Silicon Valley Bank. But nonetheless, there was a lot more transparency and confidence around the backing than there is of Tether, but that's where the money's gone now. It's just, we need a regulatory system here. Make it so it's dollar for dollar reserve, put it in a federally regulated trust, say it can only be traded on, blockchains the public blockchains where you can monitor the trade, there's, freeze and seize authority. You can have those kinds of strictures that will give legitimate people who want to do business with a stable coin, a place to do it and help not push all of them into these much less regulated venues, which is what's going on now.
How much demand is there for legitimate trade in stablecoins? That's one thing I wonder about. Given those quotes that you just read us, Josh, where come on, they're here for crime.
Yeah.
I mean, I have to confess, like when I said I was doing a panel on Bitcoin, everyone's like, "Oh, you're going to do a panel on tulips next?" And there is a sense that there's speculation and there's crime. Is there anything else? I mean, obviously you guys think there is, but what do you think? I mean, you've spent some time looking at it.
I think, a lot of what has been in the past is in the dodgier category, but I think Sheila's raised a number of the potentially positive uses, like, the idea that send money overseas, and someone who lives in a different country than where I grew up, it's every time it's a complete nightmare. Even with the whizziest fintechs of TransferWise and all this stuff that's supposed to make it easier, it's a bit easier, but it's still a complete nightmare. And so, there's a lot of stuff, I think, if you look at our banking system and the way money moves around the world, just in a simple, from a simple point of view, you think, surely we can do better than this. And I think that part of the sell of crypto was, what I've just said is something that was said over and over again at the FTX conference, which was about this time last year in the Bahamas, where another Clinton, Bill Clinton, was on stage with Sam Bankman-Fried, as was Tony Blair. This line, right, like we could make international payments better, was something that was adopted by the crypto people to sell themselves, even though what they were doing was not that. They were enabling speculation and, by the way, at the same time, taking money out of the cash box at the end of the day. But actually, I think it's a good point that Sheila's raised. We could have a better and cheaper global flow of money, and that would be great for a lot of people, but, particularly in the remittance issue, people trying to send money back home that they've earned in other countries. That there are some uses, and then I think there's some other, possible applications for the technology that maybe would be less obvious to the consumer. I mean, a lot of this seems like kind of quite nerdy, kind of more, backroom stuff that, that would improve, the way certain, trading systems work or recording data works in a way that we might, as the consumer, not even notice when you open your bank app on your, on your phone. But in the background, it could be a better database or it could be a better system. that was also part of the sell on crypto. But I think that there's a lot of smarter people than me looking at it, and they probably wouldn't still be looking at it if there was nothing there.
Yeah, no, I think retail payments is and CDB too. I mean, businesses, a lot of small businesses I know would love to stop paying those exchange fees every time somebody uses their credit card. I mean, transfer money from one point to the other directly. Actually, the Fed is using a form of blockchain right now with this FedNow system for interbank transfers. They are using a blockchain because it's just faster. And as opposed to before where they're routing money through trust accounts and everybody's committed to a certain payment and then it still takes a couple days to get it from one bank to another. Now it can go directly from one bank to another on a blockchain. That's what the plumbing is of FedNow. So it does have legitimate uses. Even the Fed's using it.
It's not just tulips. On that, should we ask, for those of you who are dedicated enough to be here, you should get to ask questions. Here, there is a microphone. Wait for the microphone.
Thank you very much. Thank you very much. Sorry about that. I've heard about rogue actors, bad actors, about going overseas. I wonder if any of you could care to comment, and maybe I'll ask it in two parts. You would care to comment about the implication of Bukele's crypto experiment, Bukele in El Salvador. Adoption of Bitcoin as a legal tender. Some have thought of him as SBF, except that he's a sovereign SBF. That whole experiment is non-transparent. It's been done with public money. I mean, he buys, we don't know anything about it, but still, if you would care to comment. And perhaps a more direct question to Cboe Digital. Would you deal with Bukele and his crypto experiment? And if so, what would be, what would be the safeguards that you would put in place if you were to do that? Thank you.
Who wants to jump in on El Salvador?
I mean, I can try. I think it was, probably for me to tell the leader of a country what not to do, but I don't think it was a very good idea, right? I think that, a colleague of ours, David Pilling, who's is a real expert on developing economies, wrote a great column about this in the FT that you can read, basically saying, if you were looking at the economy of a country like El Salvador, other countries that were considering adopting Bitcoin as legal tender and said, what does this country need? The answer was probably not Bitcoin. I mean, not a wildly unstable official currency and a volcano city thing that was not really clear, and the crypto bonds that never happened. And in Canada, where I'm from, we had now the leader of a major political party talking about let's get rid of the dollar and use Bitcoin, and he could be prime minister. So I think he's probably not talking about it anymore because probably the populist wind has changed. But I don't think it can be a good thing for an economy to be relying on an asset as their currency that is based on nothing and that changes in value as much as Bitcoin does. I mean, if you imagine the dollar in your pocket, could go from being worth, a couple of thousand up to 60, back down to 20, jumping around like this, I can't see how that is what an economy needs to be stable.
Well, remember, Tesla stopped taking Bitcoin as payment for its cars because it was doing terrible things to its bottom line.
Yeah, that seems like a good, if it doesn't work for Tesla, maybe not for El Salvador.
Did you guys have a policy on El Salvador?
I can speak broad strokes only because I would have to, we'd have to actually do a lot of due diligence on any individual, regardless of where they're from, even leaders, and some leaders are, sanctioned and, politically important people that sometimes just can't, onboard based on different sanctions and lists they're on. So there's a huge kind of global database that, tells us specific actors that we can and can't do business. And then on just a basic jurisdictional world, every single jurisdiction outside the U.S., so every single country is going to have different KYC, AML kind of requirements around doing business in that country. And some of the countries have more mature rules of the road, specifically for crypto firms, virtual currency, something called VASPs, just your virtual provider of services. And some don't. And so some of them, it depends on where in their laws it falls. And then you have your construct that says, these are your rules of the road. specifically for Cboe Digital, we have our policy internally, regardless of what jurisdiction we operate in, we have a policy, and that basically is the policy of the high watermark of all the jurisdictions we do business in. So even though we may do business in 2 separate jurisdictions, we're going to provide the same checks and processes and governance that we provide for all of our customers based on the highest watermark. So if that highest watermark is the US, then everybody that trades on our platform gets the same treatment, because we believe that's the best prudent way to offer access regardless of where it is. And so that's, as long as that person passes all the checks and balances, we would more than happily do business with them as long as we saw clarity and coverage in being able to do business in that jurisdiction.
Here's another question. You slightly beat them, but we'll go to these guys next. So go.
Yeah, the FT's Rob Armstrong wrote a while back that crypto, or I think he really meant Bitcoin, should be thought of as like an equity in risk terms. But central bank digital currencies, which seem to kind of go forward, stop, start, or even maybe stable coins, are much more like an alternative to a T-bill or a bank account. So I'm just wondering if you could all comment on whether that's the case and whether the challenges to fractional banking, which are pretty obvious at the moment, are giving people thought about whether that's possible, or the issues in all of that.
Yeah, no, I think there is a real issue about the impact on money supply, and so I think it needs to be dollar for dollar backed with cash or short-term treasuries. You certainly don't want to. And so the President's Working Group originally came out with a proposal to have banks be stablecoin issuers. And I thought, wow, so all that money's going to flow into stablecoin. You're going to use fractional reserve banking to and it's a former chair of the FDIC thinking this is not a good idea. So yeah, I think that you contain that problem through requiring that short-term treasuries have to reserve against it. I do think that helps. But that underscores a larger issue, I think, which is to the extent the incumbent system is threatened by this technology now, and we do need to carefully guide it. But what we don't want to do is use regulatory powers to staunch otherwise good innovation because it threatens large incumbent intermediaries. So I hope that answers your question, but I do think that issue can be contained through reserving policies.
And there were questions here.
Thank you for that. It's in relation to the comment about El Salvador before. There's actually an article that came out in March of this year that said that they've been dollar cost averaging with Bitcoin on the way down, and have actually paid off an $800 million bond as a result. And they've already started addressing another $800 million bond and only have $360 million left. So, and it seems to be working in that country. Maybe the article is questionable, but there are multiple articles in March of this year that actually say that. I actually have one up from Yahoo Finance right now.
I think the thing about it is it worked on the way down. What happens on the way up? If it ever goes up again. I mean, yeah.
Cost average on the way down. Maybe not the best investment plan, but it worked for them.
It absolutely did work for them then. The question is whether you want, well, who knows? Maybe it becomes more stable.
I mean, I think, are you using it for investment, a store of value, or are you trying to use it for payments? It's terrible for payments because there's just too much volatility in it.
But if you have an economy that's got hyperinflation, you have something.
Yeah, well, that's what, it'd be nice if they had access to a dollar-backed, I'm sorry, that's one of the reasons why I think you have such tremendous demand in these countries for a dollar-backed stable coin.
Well, I'm not disagreeing with the stablecoin.
Yeah, no, I know. Okay. But that's better than Bitcoin. Yeah, okay. Then we agree. Good.
Question here, and then over there next time.
So my question more or less relates to the end game for crypto in its current iteration, right? So, and this is specifically to the question of whether you foresee the potential for an outright ban. In the U.S., we had in 1934 the Gold Reserve Act, right, which banned private ownership of gold for decades, and you could foresee a situation where we're running, twin deficits and have over $30 trillion of debt, increasing by another 20 trillion over the next couple of decades. So every country wants primacy of its own monetary policy, right? U.S. may be no different in that regard. So, thoughts on the potential for outright ban across the world, but also here in the U.S. as well.
I mean, I can start maybe. I think I think that would be very unfortunate. I mean, not because we run a crypto exchange and then clearly no one's going to be able to buy and sell, but I think more toward what Sheila mentioned earlier, and that would stifle just a tremendous amount of innovation in the technology that really is kind of, I think, being thrown out. I think with your term, thrown out with the bathwater. And I think that the conversations that I see happening on the Hill and with the regulators are positive. Now, are they maybe taking longer than some of other countries? Sure. But I mean, we've never really gotten anywhere with rules and regulations quickly. It's always, we start somewhere and we involve them and we get better as we evolve. So I think we'll get there eventually. But I think that would be, that would put us behind from an innovative kind of hub or technology or country if we were to do that. So I hope not.
I'd agree.
And I would say from our reporting, there does not seem to be much interest in banning at the moment. I mean, there are definitely, there are folks who want to keep it out of the American banking system, but I don't think anybody's going to run around saying you can't go buy stupid speculative assets if you want to.
Right, and yeah, traditionally we've not done that. I do think you need to distinguish between tokens that are backed by real world assets and those that really aren't backed by anything. And the latter really are speculative, and I don't know that there's much other use for them. But when you tokenize a dollar, you tokenize a security. The treasury market's another area with which the liquidity issues are partially caused by lags in settlement times. And if you could use a blockchain to have real-time settlement in treasuries, I think it would do a lot to improve liquidity. So I think tokens that are backed by real-world assets, that's where I see the value in this technology. Those that are not backed by real-world assets, and I think you're seeing that distinction being made with the European and UK frameworks. And the latter are more treated like gambling or highly speculative and subject to much tougher rules and a lack of any kind of regulatory imprimatur of approval, if you will.
We have someone over here. And this may be the last question, depending on how wordy it is and how wordy our answers are.
Yeah, thanks for being with us today and for an interesting discussion. I had a question on FTX's bankruptcy, and there's some talk up there on like real world assets, and I think Josh, you said based on nothing. And so with the just sheer complexity of unwinding FTX and the bankruptcy, I was wondering if you could provide some more color. I'm not a bankruptcy lawyer, but for the layman amongst us, just how challenging that is in the digital sphere when it comes to a bankruptcy of the size of a digital firm like that.
Yeah, I mean, I'm not a bankruptcy lawyer either, but I did talk to a number of them, when we were reporting on the bankruptcy, which I don't do day to day anymore, but it was, I mean, this is the mother of all complex bankruptcies. This is a complete nightmare.
May give it a run for
yeah,
time.
but I think it has a degree, I mean, it's sort of like, things that people have never seen before even. And I think also,
right,
the lack of, as John Ray always says, writing things down. That you're kind of coming into like, there's still bits of paper flying around and where even are the assets? I mean, we looked at, to give you some context, like some of the internal records from FTX that were put into the data room. So when they were just trying to prevent filing for bankruptcy, FTX went out and tried to raise new equity. So they were going out to investors, and the investors they were talking to were given access to certain information that they then passed to us. So some of them. So we were looking at some of the records of the same investors that, in real time that the investors were looking at, and these are like Google spreadsheets that have columns here and columns there and little notes written into them. There's one where Sam is written in like, I feel really bad about this part, or like, this was my biggest mistake or something. And you can go obviously in the metadata on a file and see who created it, and Sam himself created it. And so we later learned through the reporting at that time he had about 5 people working for him. And this was their best effort to show the people that they were trying to ask for investment their financial position and what assets they had and where they were. And so this is, when John Ray says that they walked in and there were like no records, I think I find that credible, despite that Sam has done his best to make trying to create controversy around whether John Ray is being totally honest or trying to portray things as the worst possible version. But what we saw looked pretty bad. And so, you can see they are spending a lot of money on consultants. I think, that's not good for the creditor at the end of the day, but I can understand that there'd be a lot of work for those consultants to do in trying to figure out where all the assets are, secure them, just telling that they still haven't come up with a number, right, of how big is the hole, how much money are we missing here, because they're still trying to pin everything down, identify all the bank accounts. This is a real nightmare. And I remember speaking to one of the lawyers who's involved, and this is the lawyer who was involved in many of these other cases, and they found it incredibly daunting to tackle this. And they even said that publicly. This is going to be a really, really painful one.
As somebody who covered the Lehman bankruptcy, there at least it was basically written down. It was even there. It was a little harder to figure out where. But there were in general people had they had safes full of pieces of paper. I mean, because they still hadn't ever properly digitized their derivatives. But they did have pieces of paper with signed contracts, which I think FTX did not.
They were lending themselves $1 billion, and then they would write the paperwork later.
Yeah, I mean, it's like these are the people who find $50 million down the back of the couch.
Yeah. There's another find the back of the couch moment where they updated how much cash, the bankruptcy team was updating the public on how much cash they had found, and the number went up by $1 billion, I think, in 2 weeks as they were finding more bank accounts. Someone, FT reader, wrote under one of our articles, that must be a really big couch. So, this is a good joke. We do read the comments, and I appreciate the jokes.
Yeah, we do appreciate that. I think we have, unfortunately, I can see the little blinking red light. We have exhausted our time. Thank you for being an interesting and engaged audience with really good points. And thank you to our panel for their really thoughtful time.
Thank you.
And I think this is the moment where I'm also supposed to say this is the last event on this stage. And we wanted to thank Cboe, who are helpful for sponsoring the stage. Thank you.
Great.
Take care, guys.